In this session, I'll take you through what is loan moratorium. It's the hot topic now because of COVID impact and RBI resolution framework 1.0 and 2.0. First of all, what do we mean by moratorium? It is a legal authorization to the debtors or say the borrowers to postpone the payment. Okay, so it is legal, and this moratorium concept can be divided into two categories. One, the moratorium which is given at the time of sanctioning the loan itself. So that is not part of restructuring. Okay, that is not restructuring. That does not come under any resolution framework. Whereas the second one is the moratorium given as a part of restructuring, loan restructuring. Let me first take you through the first component, that is moratorium given for the project implementation period, that is moratorium given at the time of sanction of the loan itself. Just visualize or imagine this line as time frame. So at time 0, year 0, say now, a loan is sanctioned and it should be repaid over a period of 6 years. And there is an additional information that this loan is going to be used for implementing a project, and that implementation itself will take 6 months time. It means in the 6 months time period, that project will not generate any revenue, and so the borrower will not be able to repay anything in this 6 months period as well. So this is the information we have in the background. So here in the 6 months, this borrower is not going to generate any revenue. So it is not fair on the part of the bank to expect the borrower to make repayment when he is not making any money. But what is the information we have? The information is loan should be serviced over a period of 6 years. That is year 1, 2, 3, 4, 5, 6. The loan repayment should happen, but it is not fair on the part of the lending institution to expect a repayment for the first 6 months when the borrower is not going to make any money. So what the financial institutions will do? They will give repayment holiday for the first 6 months because there is no income generation. So in this period, there will not be any principal repayment, and whatever the interest, that will either get capitalized, okay, it will get capitalized and it will be included in the cost of project itself. So that will be in turn funded by the bank itself. Okay, so here what's happening? The overall tenure is 6 years. First 6 months there is no repayment at all. It means the entire repayment will happen over a period of remaining 5.5 years only, 5.5 years only. Okay, so this is the moratorium given considering the project implementation period. This is given at the time of sanctioning the loan itself. So this is not a restructuring. Okay, let's be very clear about this moratorium, number one. Number two, the moratorium which are given as a part of loan restructuring. And now we have RBI come out with resolution framework 1.0 in the last year 2020 and 2.0 in the current year, that is 2021. In resolution framework 1.0, RBI came out with 3 months of moratorium and it was extended for another 3 months originally. Okay, then in resolution framework 2.0, RBI said whoever have not availed the resolution framework 1.0 restructuring or moratorium can opt now, and they can even avail 24 months of moratorium. Okay, when I say moratorium, it's basically a kind of repayment holiday which can be interest holiday or principal holiday, or it can be a combination of interest and principal holiday. Okay, but the condition is it is maximum for a period of 24 months, and if that borrower has already availed the moratorium under framework 1.0, then only the balance can be availed. It means if he has already availed a 6 months moratorium under framework 1.0, then only balance, how much? 18 months can be availed, because the overall is 24 months. And this resolution framework 2.0 is also providing for extension of the tenor. So the combination of moratorium and extension of tenor should not exceed 24 months. That is the condition. Okay, now how to visualize that? Let's take this time frame. Year 0, loan is sanctioned with the condition it should be repaid over a period of 6 years. That is year 1, 2, 3, 4, 5, 6. This entire loan should be paid. And Let's take this scenario where the borrower has repaid his entire first year obligation without much of difficulty. Then when he entered year 1 and 2, this pandemic had struck and he faced difficulty and he is not in a position to pay now because of the liquidity constraint. So he is requesting a repayment holiday, not for 24 months and all. He is requesting only for 1 year, that is from year 1 to 2. For that 1 year period he is requesting a repayment holiday. He can either request for interest holiday or principal holiday or a combination, and that would again depend upon the bank which is going to approve that. Okay, if he opts for this, then what will happen? In this 1 year period he will not make any payment depending upon the moratorium which he has selected. So the overall tenor is 6 years, of which 1 year he has already paid. What is left over was 5. Out of 5, for 1 year he is not going to make any payment. It means in the remaining 4 years period he should make 5 years payment. Okay, because ideally he should have paid for 5 years. For 1 year he is not going to make any payment at all. So in the remaining 4 years period he should make 5 years payment. So this is going to have a side effect. The side effect is his EMI will increase. His EMI will increase for two reasons. Reason number one, what he should have paid over a period of 5 years he is going to pay in 4 years now. So there will be an obvious increase. And number two, if he had availed interest moratorium, that is if he did not pay interest in this 1 year period, then that will also get added with the loan amount. So he will also end up in paying higher interest, that is if interest moratorium is also availed. So this aspect have to be taken into consideration. And when he avails this moratorium, this will also impact his credit score, because his account will be flagged or tagged as restructured under COVID-19 when the bank report to credit reporting agencies. And there is another option where he can extend another 1 year, because he can opt for 24 months period, because in this case he has availed only 1 year moratorium. So to manage his EMI, what he can ideally do is he can add another 1 year. So the overall loan tenor will become 7 years from the original sanction level of 6 years. And in case study section, I'm going to add 3 to 4 case studies where I'll be discussing each and every scenario. That is, what will be the impact when he avails 6 months moratorium, 12 months moratorium, 24 months moratorium, and 1 year moratorium and 1 year extension. So please do check the case study section where you will see the practical calculation aspects, real life aspects.
Thanks for watching this video, and I hope you liked this lecture. If you wish to learn more on the areas related to this topic, check our comprehensive course. I have shared the details and link in the description below. Click, sign up and enroll. I'll see you inside the course.